Okay, there we can see my screen. Go from there. Okay, so today's class is the gift that keeps on giving. It's really going to be talking a little bit about taxes and how they work, different kind of taxes. I think the one thing is that I get clients who come to me and they say I have a tax problem, but sometimes they don't even understand what or which taxes they have a tax problem with. And sometimes that brings up an area where I have people come, the IRS is trying to attack me, but it's not an IRS issue. It's sometimes it's a property tax issue. Maybe there's a franchise tax issue if you're a business owner and you're trying to pay franchise taxes, right? Sometimes that's an issue, for the individual. So today we're just going to go through the different types of taxes. And my goal is to have this ongoing kind of monthly webinar to talk about different aspects for entrepreneurs or W-2s and business owners. And for some of us who have split income, maybe you are a W-2 wage earner, you have a job, and then maybe you have your business. And I think when I get clients who have tax problems, that's what they have. Sometimes they started a side business or a side hustle. They've started this business and they haven't allocated, they haven't done anything for estimated, taxes or quarterly taxes. And we'll get into a little bit of that in a minute and shortly and go from there. So, I'm gonna go and get to the website. Hold on 1 second. So let me see, where did that go? All right. So of course, disclaimer, this conversation is for educational purposes. I'm not giving legal advice. Some of the stuff today won't even really touch on legal. Most of it will be more tax related. But as a business owner, as a corporate attorney and outside general counsel for companies, it's important to talk about tax and know about tax and to give this educational piece for folks. I would say if you do have some questions, we have a lighter, smaller room today. So if you do want to chime in, my paralegal Asharina is on. And so if you put a question in the chat, she might get it, and then we can answer some of your questions a little bit more live. I would say if it's too technical or that you're going to be sharing some confidential information, I would say don't do that. If you have a general question or you need some clarification, then please jump in on that and go from there. Okay. So the one thing we'll get started with is personal income tax, right? You work, you have a job, you get paid, you get your W-2. I think we all somewhat know what that is and what that looks like. It's just a tax on your earnings. If you do your tax return, you'll submit your federal tax return, your 1040 form. And these are the taxes that come out of your check. If you're a business owner, we'll go through those later too for self-employment. But right now, this one is more for your W-2. So one of the things that the tax tips is you can, deduct your mortgage interest. You can deduct your student loans. You can do pre-tax dollars on your, 401k or individual retirement account. And then you also have some credits that you can use. And credits are pretty good because a credit you don't need to deduct, right? From a self-employment standpoint, you have a business, you make $100,000, you want to deduct your expenses from that or from those earnings. So now you have less taxable income. If you are W-2, once the Tax Jobs and Cuts Act was introduced, most people who work W-2 couldn't make those itemized deductions anymore. It's one deduction and it's called the standard deduction. And so for an individual person, that's about, I think, $13,500 $500 for an individual, and a married couple, you get that standard deduction. And when I go to the next slide, we'll do that. But you can use tax credits. And so that's when you have the tax credit for a child is, hey, on my taxes, I get a credit for having a dependent. Even if you don't have a child, most people, as your parents get older, you can use your parents as a tax credit, right? Because they're an older person, they're a dependent, so you can get a dependent tax credit if they qualify. Maybe they're living in your house. It can be a father-in-law, it can be a relative, maybe even an aunt and uncle. So if you are a W-2 worker and you want to look to get some of those benefits, that may be an option for you. So one thing I wanted to share, which a lot of people sometimes know or don't know, is that when you are a W-2 earner, you're not taxed the same amount on all of your dollars, right? So this graph shows you that there's a progressive tax rate on what you get charged from the IRS on how much you make. So that first 10,000, you're only going to get 10% tax, right? And so this is why sometimes in an estate planning situation, we would want certain individuals to get or kids or minors to get the money because they're only going to get taxed 10%, right? On that first 10K, So if you have a child working, you might have that option. Now, when you make 10K to 40K, you're in about that, what's that, 12.5 range. But you can see here, this is a 10% jump if your salary goes from 40K to above, right? And so
Antonio,
yes.
if you could reshare your slides, we're unable to see them.
Oh, okay. Thank you so much. Sorry about that. Let me go back. Oh man, I just was talking. Can you guys see the screen now?
Yes.
Okay, awesome. Okay, so sorry, I could not see the chat or anything, so thank you for jumping in. Okay, let me go back a little bit because I'm sure that was new to me. Okay, so let me see if I can go back. Give me a second. Okay, go back. Okay, can you still see Ashrina?
Yes, I can.
Okay. All right, so this was what I was showing on my screen. So this is your personal income tax. This is how much you would get. So those tax credits I was showing here, there wasn't a lot on this slide to discuss or go over, but this was the slide that I wanted to show, the progressive tax rate. So in this first bar, you have that 0 to 10K, that this is what you would get. Your tax rate would be 10%. 10 to 40K would be about 12.5%. And then you got this huge 10% jump if you start making over 40K to 85. And it's significant. So even if you make even beyond that, beyond the 85, it's still very small. And so for the most part, I put it up to 150 because most people, you still get the standard deduction, right? You'll get the standard deduction if you're in this bracket. You get to continue to take your student loan interest. And sometimes you can lose the child tax credit if you make over a certain amount of salary. And sometimes it fluctuates because I'm putting 150 here, but it could be different, right? Maybe you have some other deductions that you've taken and gone from there. So I did want to put in a little bit of an example. This basically just spells out what we saw in the graph, that first 10,000 earned, you're at that 10%. So many kids, they can make 10,000 before they really have to pay, a lot of taxes on things, and they may still qualify. And we'll get into Ross and stuff like that in a different meeting. But then you can see the tax bracket on how it grows. So one thing we talk about when we talk about taxes on that personal income level is your Social Security and Medicare taxes, right? And this is a definition of what payroll taxes are. And I think sometimes people get confused on, man, I'm so much is coming out in taxes. What am I going to do to offset it, or what am I going to do to prevent that along with those tax credits? So those tax credits help you to help release or minimize some of your federal taxes, right? That's what we were speaking about before. You had these federal taxes that always, not always, but are going to come out your check at that progressive tax rate. But now you have your Social Security and Medicare taxes, and that's always going to come out. So we all know what Social Security and Medicare are, I believe. So I think most people don't always know that your employer pays half of that FICA and then you pay the other half. So if you have a W 2 job, you're paying that 7.65%. But if you're self employed, you're supposed to pay that 15.3%, right? Now you can deduct that, right? You can deduct half of that portion of that self employment tax because that's the part that you're paying because you're basically paying the employee portion and the employer portion of that 15.3%. And so you want to keep track of that because you can deduct that from your revenue as a self-employed person. And so that's one thing too. When I get a new business owner that comes in, I try to explain to them, yes, whatever you're making, let's start to keep some money into a different account for taxes because it's going to come out to haunt, hopefully not haunt you. And you won't be coming saying, hey, now I owe, 50,000 on top of penalties and late filing, because honestly speaking, if you're self-employed, you should be paying quarterly taxes, right? Because the IRS sees it as you're making the money, you should be paying quarterly taxes, not yearly taxes like a W-2 person, more so because the W-2 person is paying taxes all the time with their check, right? When you get paid, the taxes come out, so you're already paying your taxes. As a business owner, you should always or sometimes think, you know what, maybe I don't pay taxes quarterly, but maybe at least biannually or semi-annually, I'll pay some taxes. Okay.
Antonio,
Yes.
yeah, it's not only something for quarterly. I have to pay every month. I'm paying taxes every month.
That if that's your schedule that you have for yourself, you can do that. Most of the time when I do a tax return for a client, we get invoices, quarterly invoices. And normally they pay those estimated taxes quarterly through the ETPS system, and you'll pay those. And sometimes it's a guesstimate, but if you're paying monthly, that's fine. But I think quarterly would serve you as well, and you could do it that way. Okay.
No, I think I got a letter saying, no, I need to pay. I was paying quarterly in the first 6 months. I was told, no, I need to pay based on the earning. I need to pay monthly.
Okay. Yeah, please, when we get offline, share that information with me. And we can see if we can do something about that, or if there's another reason for that, right? Maybe they're like, you're generating too much, but I've never seen them really try to impose someone to pay monthly. And again, it may be something else. Because here in Texas, for most of you, some of you in Texas and some of you are not. Texas, again, there's no state tax, right? There's no state corporate tax, but there is a franchise tax. And we'll talk about the franchise tax in a little bit. Okay, thank you. All right. All right. So now we've talked about W-2 earners, which is, most of the population, has a job and they work. That's their taxes. Now, as a self-employed person who has your own business, now you have self-employment tax. And this is a tax on your earnings as a self-employed individual. The IRS wants their money. And what we talked about before, this self-employment tax is what's going to cover that FICA tax, what we discussed, and where you can still deduct some of that from your business expense and lower your taxable income as a self-employed person. This is just a slide again, kind of explaining a little bit that there are two taxes. So people know there's a federal income tax that you'll put on your Schedule C that we did the chart for, and then you have your self-employment tax, which is separate, but sometimes people don't know there are two taxes here, that they're separate. So I wanted to highlight that. Okay, we can skip this slide. Okay, so this is how somewhat a person would calculate what their self-employment tax would look like. I thought this would be a good exercise because some of us do go to tax professionals to handle this, But I think as a business owner, you want to kind of know what your numbers are looking like, or at least have a sense on, okay, where's a little bit of what my tax situation may be at the end of the year. So you're going to start with that gross income. You're going to subtract your allowable business expenses, which could be, maybe you bought a new computer, new software. Maybe you have contractors, you got staff, travel expenses, and there are certain guidelines. Maybe you have a vehicle that you use for your business and you'll have that vehicle set up. So those are some of the business expenses that you'll include. And then you'll have that, you'll multiply that by that social security number, and then you'll be able to deduct that 15.3 to 7.6 and take that off. So the example here is my net income is 100,000. That 15.3 is this Social Security and Medicare. So that's 100. So you have that 7,600 that is going to lower your income. So now your income will be, what's that, 93,000. And that's what your federal tax will come out. So you do get some savings on that FICA or Medicare and Social Security off your income. And this just kind of shows the flow of it again, which includes the federal income tax. So now you have the 100,000, you're at the 92, and then your calculated base that you'll pay your tax rate on of about 22% would be about 92,000. And I think the tax for that would be about, I think it was 20,000. Okay, so now we have a corporate income tax rate. So some of you as a business owner, we kind of guide a client from, hey, I'm a W-2. Now I'm a business owner. As a business owner, now I have to pay these self-employment taxes that I didn't know about. And I think that catches some people, especially if they are new, again, side hustle. Maybe you were a gig worker and you started making more than what you thought you were going to make. A couple $1,000s started to come in. One thing I will note for people, if you are getting money through Venmo, PayPal, and some of these other third-party payment centers or Square, they're going to have to start reporting your financial data if it's over $600. So be ready for that. Be ready to have 1099s and be ready to record that information. I just wanted to share that really quick while I was on top of my mind. So there's corporate income tax. This is for a C corporation, right? So if you're a W-2, you're not a corporation. If you're a limited liability company, you're a disregarded entity, and you're still paying a sole proprietor tax rate or an individual tax rate. Some people decide to be an S Corp, and that's a different tax classification. But this is for a corporation, what we would call a C Corp. So there's just tax on corporate profits. Most individuals choose not to be a corporation because of double taxation, right? So you have this corporate tax, and then you have an individual tax. And we'll go through some of the slides that shows that. So when the Tax Jobs Cuts Act came, Trump lowered the federal corporate tax rate to 21%. I think it used to be 35 before, but he cut it to 21. And then you can deduct your business expenses, of course, from the corporation income and lower that. Trump is discussing lowering the corporate income tax rate to 15% moving forward when he gets into office, but we'll see what that looks like when it happens. The good thing about corporate income is, though, you can carry forward your losses to offset your profits. And that's what a lot of companies, these bigger companies, they're not paying any taxes, but they're making all this money. Yeah, but they know how to show a loss on their books because all the money that they're making in revenue they're generating, they're putting back into the company. Put it back into research and development. Some of it you can keep. It's called accumulated funds. And it shows that, hey, I have accumulated earnings, but this money is going for research and development. Maybe it's going to technology. Maybe it's going to AI, and you're not getting taxed on that. And I think when we hear some corporations having zero tax liability, they're always showing losses on their books, but they do have good revenue, but they're just putting it out in other things like these credits, right? Research and development credits, renewable energy credits. So sometimes if a company sees that they're going to have some earnings, they can buy these credits. And we'll do another class on tax credits with Ryan Foncannon, who does advanced tax planning. And we'll talk about leverage charitable deductions, and we'll talk about tax credits on what you can do to benefit from these. So, of course, properly classifying independent contractors and employees is a big key, because the employees do take dividends from the company and own a portion of the company, as opposed to independent contractors who just work, and you can give them a 1099. So here's an example of, again, the corporate tax rate is somewhat really simple, right? You have that flat 21% rate. 100,000, you're going to pay 21,000 in corporate tax, right? I think the tricky part comes in when dividends distributed to shareholders on the individual level, is where people get a little queasy about having a corporation, because they don't want to have to pay taxes on the corporate level and then pay taxes on the individual level. But I think the individual level is a little bit more simpler if you take a dividend, right? Because if you take a salary, as we've seen before, you could be paying as high as 22%. But if you take a dividend, which is a capital gain, which we'll get into later, and you keep that for longer than a year, then you're paying 15%. So you're already saving money just by taking a dividend over a salary. And this is why a lot of even, Congress people or executives prefer stock options as opposed to a salary, because they would prefer to take their money, if they liquidate their stock or take a dividend or a disbursement from the company, over a salary. Okay, so we'll jump into unemployment insurance and workers' compensation taxes. These really vary by state. If you don't have employees, most of the time this won't come up as a factor for you. If anybody does have employees, share with me, some of the inner workings on your day-to-day. Do you find this cumbersome? Is it difficult? I know in California, it's a really big deal for having workers' compensation coverage. And it's a big deal that can get you in trouble, because we'll get in payroll taxes in a little bit. But here, unemployment insurance and workers' compensation taxes, it won't always affect everyone. You can use it, it is an expense on your business. So if you do need to carry it or have it, you would use it and go from there. Okay, so we'll talk about sales tax. So I get a lot of these questions from my entrepreneurs as well. Hey, I started a business. I have my side hustle. Do I need to include sales tax in my invoices? And it depends, right? A good lawyer always says it depends. Most of the time, I will tell you the sales tax definition is really somewhat more geared by the state. Your state is the one that's going to somewhat, tell you what you should be charging for sales tax, how much it should be, how much you can, kind of offset the sales tax to the customer, and how much you would somewhat keep in-house on yourself, and what's exempt from there. So those are, some of the sales taxes that you'll have. So here again, abide by your state laws. Most tangible personal property, of course, grocery stores or other things like that, you're always going to get taxed on that. When it comes to services, though, that's where it gets a little tricky, because for myself, legal services, so if an attorney charges you sales tax, hey, that's wrong, or accountant, they charge you sales tax, you shouldn't, be applying that. But other things like haircut, spa, maybe you go get your nails done, getting a haircut. Most of the time, the barber doesn't charge it, but they could, right? I had an interior design person who came and they wanted to charge for, sales tax, but it was like, it's not necessary in Texas, and you can't do it as a designer. It was one of the services that was exempt from having to charge it, because now you have to go up on your rates to cover that, and that needs to go to the state comptroller's office. And so I do have clients from time to time where now you're in a situation with the Texas comptroller or your state comptroller's office, and you need to be able to manage that and account for that. And it should go into a separate account, a trust account, to do that. If you sell things online, if you have online sales, so maybe you have a digital book, maybe you have a digital program, again, if you have nexus with that certain state, and nexus means you have a business relationship in that state. So I'm selling a mass amount of books here. People are going online buying from Texas, but my office is in Delaware. There's a nexus. There's a relationship when you think of nexus on a business end. And so you may be subject to sales tax. And so reach out, go to that website or get local counsel and say, hey, look, do I need to pay sales tax on this? I don't want it to come back and bite me in the end. Common sales tax, amusement parks, your cell phone. Cleaning service is a big one too. Sometimes when I looked it up, that was new to me. But transportation services. So you have all of these that have it, sales tax. And of course, you have your exempt entity. So I do a lot of nonprofit work. For a 501c3, you don't have to pay sales tax. So I think a lot of people, when they get 501c3, they think, okay, we don't have to pay taxes, right? But you also are tax exempt. So if you are going to purchase books for your tutoring program, that's a nonprofit, if you provide them with your 501c3 letter, guess what? They'll remove the sales tax from those purchases from you. If you're buying a bulk of food and things from, for a food, place for eating and helping with the homeless, there are a lot of nonprofits that do that. We're able to buy the food and stuff with no sales tax because we're able to use that tax exempt notice and letter to remove that. Okay, so we'll get into property taxes. Here in Texas, property taxes are a huge deal. And I do oftentimes get people who are confused on what taxes they need to be paying. And so this is just really taxed on your real estate. We won't go a ton into this, but I think everyone pays their property taxes. Of course, this is a more county issue as opposed to a state or federal issue. Most of the time, there are so many scams out here, right? So for most of the time, if there's a property tax issue, you should be thinking your state or your local county and what you're going to do and how you'll, address that assessment based on what their appraisal of your property are. Those in Texas, we know you can fight this. You can go to your ARB or arbitration hearing, or you can go to the planning hearing and kind of fight the property taxes and go from there. So I'll skip over that. Okay. So another good tax that we'll talk about are capital gains taxes, right? And so capital gains taxes are taxes on sale of assets, whether you're selling your home. Most of the time we're thinking stocks, stock options or other, fungible property that you're selling and those things. And so capital gains tax is done at a different rate. If you hold the asset for over a year, it qualifies for long-term capital gains taxes, which could be maybe 15 to sometimes even 10%. And I can get more information on that for anybody who wants to know. But really, it's about 15 to 10%. And so in our earlier example, you would want to take capital gains tax, as your payment as opposed to a salary, because your salary is going to probably be in a 22 to 24% tax range. And your capital gains tax would be more into a 10 to 15%. So if anybody knows, like, the highest paid employee for a state is normally their public school football coach. So we'll use Deion Sanders as an example. Deion Sanders, he's the head coach for Colorado. Colorado is the public school for that state. So instead of taking a $10 million salary, Coach Sanders says, hey, no, let me take stock or stock options or run this through my company where I can take disbursements or dividends as opposed to a salary. So if you start to see, coaches and other employees who are traditionally W-2 employees from the state, they've come up with creative ways to get their money more in investments or capital gains or disbursements than they do from a salary. And so Mitt Romney talked about this a lot when he ran for president on how to change that up. And Congress has also talked about how to start taxing unrealized gains in these situations. So type down the word, Asharina, if you can put unrealized gains in the chat, because I want people just to kind of go and look up that situation and what it'll do to impact you. And so unrealized gains, I'm going off script here a little bit, but what Congress wants to do is, hey, if you have a stock portfolio of, let's just say 400,000 and you start to get appreciation on your stock, like Bitcoin. Trump got in office, Bitcoin went from about 65,000 to 95,000. Now you have these unrealized gains because you haven't sold the stock. So the money isn't even real, it's unrealized. But they want to have a way to try to track that, and if possible tax that, and that could be very disadvantageous for us, and it cause a lot of problems because, like, hey, I haven't even seen the money. It's like your house. You get the big appreciation in your house, but if you don't sell it, it doesn't really mean anything to you unless you want a line of equity or credit or something like that. So capital gains taxes is something to look at. I think people will want to learn more about this and go from there. So one of my favorite taxes are estate and gift taxes, right? And so we're around Christmas time of the year, we have estate and gift taxes. So most people don't know that a gift tax is if you gift to anyone outside of your spouse more than 17,000 in 1 year, you're supposed to file a gift tax return. And a gift tax return is a 706 form. And this is the form that you would fill out that says, hey, I gifted, so let's say, I buy my daughter a new car for her 16th birthday. It's a BMW, it's 35,000, right? So I'm supposed to pay, if it's 34,000, I'm supposed to pay gift taxes on that 17,000. But what we have is what's called a federal exemption. And this federal exemption amount is $13 million. And so what this does is, hey, in my entire lifetime, I can gift to anybody I want up to $13 million, and I don't have to pay any taxes on it. This is a way for America to try to control dynasty wealth, right? The goal of taxes and land tax and property taxes and estate tax or inheritance tax was to get money from the more higher ups or oligarchs to have to pay their taxes and not just have this generational wealth drop down year after year. So this 13 million, which went up when Trump got into office, from 6 million or 7 million, he doubled it to 13 million. Now, this federal exemption is supposed to expire or sunset in 2026, but a lot of us think that it's going to get continued and keep moving forward now that Trump got back elected. And then the Tax Job and Cuts Act, this is how he was able to kind of give a tax break to some of the wealthiest people, because now you have, this bigger gap in which you can give to your kids. So that's 17,000 again. Now, again, if you're husband and wife, you can gift to each other the entire world and there are no tax ramifications if you're a U.S. citizen, of course. Let me throw that in. If you're a U.S. citizen and you're married, you can gift to your wife and spouse whatever you want and you don't have to worry about it. But again, it starts to kick in when you have to drop down to your kids or grandkids and so on. So that's your gift tax. And then you have that, but that kind of relates to your estate tax too. You have different states, and we'll get into, I do have a slide on inheritance tax and wealth tax a little later. So does the recipient pay the taxes on the gift? No. Good question. In most situations, the donor, the person who is giving the gift, is the one who pays the taxes. So if I gave you $35,000, then I would use a portion of my exemption because I'm gifting it to you. Let me give another example of where this happens on this gift tax. Single mom or, has kids. I want to transfer my home, or I want my kids to be able to utilize my home and be on the deed. without having to go through probate or doing a lot of estate planning. Or maybe I'm just getting older and I want them to be able to manage it. So what mom does is add kids to the deed, right? So let's say the house is worth 500,000. In that situation, guess what? Mom just gifted, her kids basically $250,000. And so the IRS may get wind of this. I don't know how they do it, but they have somebody there keeping track of this deed that goes through, and they say, hey, son and daughter just, got gifted 125,000 apiece. We'll subtract the 17,000 that she can give to them in a gift, but now mom is on the hook for basically that 220,000 that's remaining. So she'll get a notice from the IRS, you owe taxes on this gift, and she can use this federal exemption to basically wipe out that tax obligation. And she would file that 706 form, and she would say, hey, I want to use, 200,000 of my 13.6. What I do for some of my clients is that I tell them there's something called portability, right? So if you're married, let's say you don't use your full 13.6 because you're gifting everything to your spouse. Your spouse can take everything. You do what's called portability. You port in your 13 to the surviving spouse, and now she has 26 million to gift. I think a lot of people don't really think that they have so much in assets. If you do your life insurance, your property, maybe you have rental properties, the amount of your total assets can quickly kind of get up. So when the exemption was 6 million, there were a lot of people who were always on the threshold of having a taxable estate. And a taxable estate is about 40 to 45% of what your assets are. So think if you have 7 million in assets, the exemption, you're over that exemption limit, then maybe you could be paying 40% on whatever that amount is over the exemption amount. Okay. Okay, so we did talk a little bit about wealth taxes. This is very rare now. I think more commonly what you see in certain states like Maryland, which I'm barred there too, is an inheritance tax. And an inheritance tax is taxed on what the assets are for that state. So in this previous slide, this is the federal amount, which is 13.6 million. In Maryland, the inheritance amount is 1.5 million. So let's say you might be under this. Let's say in that scenario where you had 7 million, okay, now in Maryland, you may have to pay some type of inheritance tax or do some type of planning to offset that and go from there. So that's one thing with the inheritance tax that you may have. The wealth taxes, it's an alternate income tax. I think most of the time they don't do this, or there are other ways to do asset protection trust or irrevocable trust. You also have irrevocable life insurance trust, where the person has a trust that, so for 100, there's no inheritance tax that I know for Texas. I think Maryland and there was another state that had it. But for Texas, yeah, there wasn't an inheritance tax. Yeah, I was I was happy because Texas is kind of more easygoing on their inheritance and their taxes. We'll get into franchise tax in a minute. Okay, so here we are, franchise and gross receipts tax, right? So we talked a little bit about corporate taxes, self-employment taxes, business taxes, but if you have an entity, and even if you don't have an entity, sometimes you have to file what is known as a franchise tax or LLC tax. Sometimes they'll call it an LLC tax. Sometimes they'll call it, like a business organization tax or an annual business tax. So kind of based on your state, figure out what the name is. I think a lot of people are in here are in Texas. So for us, it is called a franchise tax. And in Maryland and DC, it's called your annual business entity tax or personal property tax, I'm sorry. And so you get taxed on that based on how much revenue you had. So in Texas, before you only had to pay franchise tax if you made over $1.3 million. and you would go to the comptroller's site, put in your data and say, hey, I didn't make $1.3 million this year, unfortunately, boo-hoo, but things look promising for 2025, right? So you have that 1.3 million you put there, right? And you would go and say, hey, I'm under that threshold. I don't have to pay any taxes. And you submit your report. So now in Texas, that number has gone up to 2.4 million, that if you make over 2.4 million, or if you make under 2.4 million, you're exempt from having to pay that additional franchise tax. I do have people in California who oftentimes have to pay an $800 franchise LLC tax every year, no matter how much money they make in their business. So if you just have a dormant LLC that you're not using, it may be wise to shut it down and be a sole proprietor if you're not, and just have liability insurance. If you think I'm just doing a hobby, there's not a reason, because 800 a year could really eat into your margins and everything. The gross receipt tax is the same, because basically what the franchise tax is asking you are, what are your gross receipts for the year? And I think many of us have done the call, but if you're new and you're setting up a business, always remember, hey, let me go fill out my franchise tax form, because if you don't, then the state will revoke your business registration and now you'll be exposed to liability. And so I think sometimes I have clients that don't connect all the dots. You want to have a business or a limited liability company or corporation because you want liability protection. In order to ensure that you do that, you must stay in compliance with all the state regulations for your business. And one of those are these franchise tax and filing that with that office. Okay. All right. So, oh, wow, I did pretty good. So 1142. So yeah, tax tips, stay organized, keep detailed records. For all my clients that get audited, have your documentation. One tip that I would always say is keep your receipts that you make your purchases on, because it's the IRS wants to see a receipt. I get many clients who come and say, hey, I got my credit card statement, right? But a credit card statement just shows a transaction. It doesn't show the actual bill in which you paid for. It's almost like when you have a job, sometimes they say, submit your receipt for your health expenses, right? If you just give them the sheet that says, hey, I paid dentist $365, they may reject it because they want to see the entire itemized bill. The same for the IRS. If you have some business expenses that you think might be questionable, travel expenses, meals, keeping a log on your car when you're driving, these kind of things. Independent contractors, right? Man, I had to hire a bunch of contract workers, and they're like, okay, well, where's your independent contractor, contract with these people? Where's the payroll? Where's the timesheet that they work for you? All these things are really instrumental in your documentation, because you can fight the audit, right? Most people panic, but it's like, no, call me. Let's get your files and your documentation prepared, and let's just address it, right? And go from there. Also, too, if you use tax software, maybe having a bookkeeper can help you keep some of your taxes organized and intact, and that'll help you stay on pace on making those quarterly estimated payments, or in Mr. Hyder's case, monthly payments, and we can address that later on monthly payments. But most of the time it's quarterly or semi-annual, or you just pay at the end. Sometimes people are like, hey, I'll just pay one time at the end like everyone else, and I'll just pay a little extra for interest and maybe a little bit for penalties. And then we do have new, tax laws that will be coming out soon, and I'll update those. I think everyone here is here because they got my newsletter. If not, you can always come and join my newsletter and send these out. And again, we'll be having one of these webinars. My goal is to have it the third Saturday of every month. And so the next couple of sessions, we'll be talking about leveraged charitable deductions, which can help people save on those tax credits, especially if you're a W-2 wage earner. This really helps because you can't do anything besides your standard deduction for the most part, or you don't have enough deductions to go above the standard deduction. And then the next class in, I think, March or February will be rollover-based startups, or ROBS. And a rollover-based startup, we'll get into that later. We'll be discussing how you can get money from your retirement rolled over to a corporation through a self-directed retirement account. And now you can fund, maybe a real estate deal. Maybe you can fund other startup or business ideas that you want to get into by tapping into those retirement funds that you can roll over properly and get it done. So we'll have that then. And I'll also have a partner on for Provision Capital who will talk about rolling it over into a real estate investment trust and what that looks like. So we'll have a real life scenario on, hey, I want to invest. The minimum is 5,000. I can take from my retirement, do a rollover based startup, and then roll it over into the business and go from there and do it that way. So it's a Saturday. It's a Q&A session right now. So we have some more time. And that's my information. I think everyone knows how to get in touch with me. Thank you so much for joining the call and stepping on, and I'll open the floor up for any discussions or questions that you have. Oh, okay. Thank you, Rahana. Yes, I'm glad it was informative. I'm glad you enjoyed. Always having good attorneys on who say that things are good or nice. Are there any topics that anybody would like to see more detail on, or more slides on, or examples? Please put them in the chat. BOI. Okay. Who's O? If you can just put your name in the chat, I would greatly appreciate it. Okay, so BOI. So for those who don't know, so good to meet you. So BOI is beneficial owners information. And so earlier this year, Congress had what we call the Corporate Transparency Act. And the goal was that business owners who were not exempt need to go to the Treasury Department and file information on who the owners of their business are. And so, say for instance, I'm a business owner, I have an LLC. I would go to the site called FinCEN, and I'll put it in the chat really quick. And if you guys want a talk on this, I can do it, because I did a presentation for one of the state bars shortly. So FinCEN is where you would go and you would report what your business are. And if you had a partner, you would report their information. The thing about the beneficial owners report, it was very, very expensive. I mean, well, the fees or the penalties were very steep and very high. And so let me stop sharing really quick. So the penalties were very high on the beneficial owners report, and it was very onerous on business owners who are small, who are already very busy and trying to do their day-to-day operations. And so now there's a pause on it. So the National Small Business Association sued and said, hey, this is undue. We want to bar this. So they got a temporary injunction, but that temporary injunction was only for members of the National Small Business Association. If you were outside of that, you still had to report your FinCEN, your BOI information. But now the state of Texas has issued and gone to trial and got an injunction, and this is nationwide. So as of right now, you can still report if you want. If you still want to go on and do your beneficial owners information, they won't stop you. But as of right now, across the country, it is an injunction against it. So if you are a person who's like, I don't want them to have my information, because at some point we know that if the Treasury Department is going to get this, the IRS is going to get this information, and then they'll be able to kind of tie things together. So the reason behind it was to kind of monitor money laundering and other things, or maybe shell corporations that money launderers were using. But I think there are other and different ways to go about this than to have this onerous task on business owners, because every time you change your address, you have to go in and update it. And if you're out of compliance, the fine is $500 a day and up to 1 year in jail if you don't comply with this beneficial owners report. So I think a lot of folks are thinking that Trump and the Republicans want to do away with this owner's task and get it out of the system. So I hope that answers your question. Does someone else have a question?
I just had a comment that the VOI report is you only have to file once and there's no changes like in address or in ownership, then you don't have to file again. It's only one time.
Yes, that is correct. But most people, maybe you change your business address, maybe you get a new location. And if you don't think to go back and change that, now you could be out of compliance and subject to the fine. And I think that's where the situation is. Secondly, for someone like myself, I'm an attorney. And so for someone who helps people set up their businesses, that business owner then needs to attach my information to it and say, hey, who helped you set up this LLC? So now I have to divulge my information. Now you do get what you call a FinCEN identification number, which is what I got. So for someone I set up a business for, I can give them that FinCEN number and then they can use that. So they don't have all my personal information. They just use the FinCEN information and then Treasury already has that. So I did that because I knew I had a lot of business owners who were getting set up. But for most of you, yes, you'll do the BOI report, and then after that, you might be done and go from there. Okay.
In my case, I mean, I didn't get a FinCEN number. I just filed, I set up my own LLC and I did my own VI
Oh
report.
yeah, yeah. If you can, you don't have to get a FinCEN number. If you have your own account, you don't need it. You can just go in and under your name and continue to report under there. So that's good. Any other questions on taxes? Anything else that I missed? Again, I'll send out a survey next week. I hope everyone has a happy holiday or a restful time off on this holiday season and happy new year. We will get out a notice for the January webinar as soon as possible. My goal is to have Saturna Capital and Funding and Investment on with Hood Williams. But if not, then we also have Rand Fontanen. We'll do the leverage shareable deductions, which I think will be very, very informative for people and they'll really jump on. And then the rollover based startups with Mahmoud Usmani, and we'll be talking about provision capital. So without further ado, I'll give you back 8 minutes of your wonderful cold Saturday here in Dallas, Texas, and go from there. And I hope to see you all in 2025 and have a good new year. Thank you so much. Thank you. Thank you. I'm glad the presentation was really helpful. Thank you so much. Everyone have a great weekend. Okay, assalamu alaikum.
A reminder to stop the recording.
Oh, yeah.